All right, everybody, welcome to another episode of JAG University. Here again with my friend Yousif Mohamed from Movement Mortgage. We're going to jump right into a scenario for you here. Let's say, okay, I'm a 30-year-old here in Miami. I make around 120 grand a year. I have some money on me, so a down payment isn't going to crush me. I want to buy a condo in Brickell.
Okay.
Well, what's it looking like for me?
Well, contrary to popular belief, man, mortgages are super simple. We look at three different things. It's only three: credit, income, and assets, right? So when it comes to your credit, we're looking at your score, making sure you at least have a 620 or better. Obviously, the higher the score, the better rate you're going to get. But more important with credit is going to be what they call the debt to income ratio. So the reason why we look at a debt to income ratio is to figure out how much you can actually afford. So you said a guy makes 120K a year, about 10K a month. So what we shoot for typically is a 50% debt to income ratio. So you take the 12K a month, the 10K a month, divide that by 2, that's $5,000 a month. So what does that mean? That dude in Brickell has to have all of his liabilities and debts at 5K a month or less. That includes your house payment that you're going to buy. That includes your car, any student loans, credit cards, things like that, right? So as long as, let's say, you have only $1,000 a month worth of debt, we're factoring in a $500 a month credit car payment, $500 a month in student loans and other miscellaneous bills. That means you've had $1,000 of your $5,000 taken. You have $4,000 a month left to buy a property with. So then you're going to say, okay, well, what does that mean to me? Well, $4,000 a month is going to be different to a lot of different people. If it's a condo, you're looking at like a $600,000 condo when you factor in things like the loan, taxes, HOAs, insurance, stuff like that. So when it comes to qualification, you're looking at the credit, the actual debt to income ratio on your credit, and then you're looking at your down payment, right? So down payment is going to be how much you're putting down towards the property, but also factoring in things like closing costs. So the lowest down payment you can put down is 3%. A lot of our loans that we do for condos in Brickell are at a 3% down payment. So if you're buying a $500,000 condo, all you really need is $15,000 for that down payment, right? $50,000. And then another, let's say 3% for closing costs, things like taxes, title work, stuff like that. So yeah, that's pretty much all there is to it.
Yeah, it seems pretty simple. That's a pretty simple formula for anyone that's just trying to ballpark a property they can afford. That's pretty cool. The Miami market, that as we've seen, let's say I'm looking to buy a condo, is there any sort of differences based upon where we are as far as the state on how that'll view how you can qualify for a mortgage and a property price?
Great question, man. So when it comes to buying condos specifically, which we do a lot of because we work and live in Brickell, the condo itself has to be approved, right? So people don't really realize that. They think, well, if I got good credit, I got good income, I have the money, I can buy whatever I want. But in reality, for a house, yes. But for a condo, we also have to look at the condo's credit, the condo's income, and the condo's assets through something called condo documents. Yeah. So those are things like a condo questionnaire or a budget or a master insurance policy, things like that. So it's important if you're looking to buy a condo to work with a condo lender who specializes in condos like we do, because we have most of these buildings already pre-screened, and we can tell you, to buy at this building, it's going to require at least this down payment, or to buy at that building, you have to put down this much of a down payment, or you can't buy at that building because they have certain issues.
Interesting. Yeah. And we insure a lot of condo associations here. I do a lot myself. I insure a lot of condo associations, especially on Miami Beach. And I'm sure that's an area where some of them start to fall under a little bit more scrutiny. Yeah. Following Surfside 1, following the general age of the buildings.
Right.
They're aging assets. They need more maintenance, more updates. Insurance costs are kind of skyrocketing for some of these buildings. So a good idea, when I think of a condo that is more likely to be approved, it's probably going to be a newer building.
Yeah. So, when it comes to the insurance aspect of it, we need to make sure that they understand what the guidelines that Fannie Mae requires are. So when it comes to how much flood insurance you need if you're in a flood zone, how much theft and fidelity coverage you need, when it comes to reserves, how much reserves they keep in the bank, are they under litigation? Is the litigation Surfside-esque? Are they suing for construction defects, which they call a 558 claim? So all these different checks and balances you need to look out for. So it's not necessarily newer or older building. It's more so how is that building financially, right? Yeah. So how are they doing with their budgets? How are they doing with their lawsuits? How are they doing with their insurance policies? And insurance is a big part of it,
Yeah. That makes a lot of sense. So, we kind of covered the basic loan premise. We've covered having your condo building approved. What are some common pitfalls that you've seen with people trying to get a loan and buy a property that, most people might not expect?
People might not expect. Well, I'll kind of flip it on you a little bit, Kevin, and I'll let you know that a lot of people that come to us and want to buy property, they don't realize that they can literally put down as little as a 3% down payment.
Yeah.
A lot of people have been renting for years and years and years, and they think, I want to buy a condo, I need 20% down, right? So they end up saving a bunch of money and renting for, a decade just to save enough money to buy a condo. And then we come and tell them, you didn't know you could buy this for 3% down? They're like, no, nobody ever told me that, right? So the pitfall is that they waited so long to make a purchase, and the people that kind of understand that dynamic and the agents that are spreading the word of low down payment financing are really helping, especially millennials too, break into this market and become homeowners. The cost of rent right now is absolutely insane. We have buildings going up 50, 100% in rent year over year.
I see it all the time.
Crazy. So we were talking about it before this episode. So if you could purchase something for the same amount of money that it would be to rent it, not only on a month-to-month basis, but also in terms of your initial investment, most of these buildings are still asking you for 2 security deposits, first month's rent, last month's rent.
That's
so
true.
when you factor that in, man, and you think, man, I could just own this place and it could be mine and I could be building principal and all I got to do is put 3% down. I mean, there's cool opportunity here, man.
Yeah, 3 months of rent up front, it's like $10,000.
Yep, that's it. And that's a down payment on a $300,000 condo.
Yeah.
Crazy.
That is crazy.
Yeah.
And, so basically, things to keep in mind. I want you to recap that initial debt to income formula. I think that's the biggest piece for our listeners, just to get a quick ballpark on a property they can afford. Can you run us through that one more time?
Yeah, super simple. So debt to income is simply debt divided by income. So debt is anything you pay month over month plus your housing payment divided by how much money you make a month. So if you make $10,000 a month, you can have $5,000 a month in debt. That can be all house or that can be house and other stuff.
Yeah. So in a condo, that would be mortgage payment, HOA. It can include your car, taxes, insurance.
Exactly. Yeah, your mortgage payment, which is principal and interest, taxes, insurance, HOA dues, and sometimes mortgage insurance, we'll save for another time.
Yeah.
Plus your whatever else you have, cars, student loans, only things you actually owe money on divided by your income. So if you're making $10K a month, you got $5K to play with. That $5K is up to you to decide how you spend it.
Essentially, what I'm taking away from it, and what I believe our viewers should as well, is a mortgage is maybe simpler than you think.
Yep.
Getting the money to buy a property is cheaper than you think, as far as down payment, interest rates still being low. So it's definitely something that people should be considering a little earlier in their lifetime than they tend to, just because of some of the preconceived notions that they have as far as how much capital they need upfront to make this purchase, or the level of income they need to be able to be approved.
Yep. We love first-time home buyers and we love condos because there are two markets that aren't necessarily focused on in our industry.
Yeah.
So if you're one of those two people, I urge you to open up a line of communication with Kevin and myself to understand kind of where you stand, because you will be very surprised.
Awesome. And I know you work a lot with realtors. Do you ever work with direct home buyers as well? Did they ever reach out to you directly?
100%. We've been doing this for a while now. So a lot of our book of business is past client referrals. So people referring their friends because they've gone through the process and they're like, wow, do this for my friends. And I'm like, of course we're going to do this for your friends. So if your home buyers are looking to purchase something, definitely contact us and we'll get you guys some cool information.
Awesome. Yeah. And you have a very active social media as well. And I've seen you posting pictures at the closing table with purchasers. And I don't think I've ever seen another mortgage guy do that. I'll see the realtors in those pictures at those tables, but I haven't seen guys like you on there. I thought that was always really cool. So before we sign off here, why don't you tell our viewers how to see your content and how to get a hold of what you do?
Yeah, I appreciate that, Kevin. The best thing you guys can do is follow me on Instagram. It's @thefitLender. I post a lot of educational stuff there, but it's the easiest way to connect with me ASAP. We're very responsive on that site, and you might figure out or see a video that you want to dive deeper into. And
Awesome. Well, Yousif, thank you very much for joining us again. I really appreciate it. For our viewers here, we had another episode of JAG University that we filmed, as well as in our segment, Building the Book, where we talk a little bit more about sales, coming up in the industry, and building your business. Thank you, everybody. Enjoy the rest of your day.
Thanks, guys.